Now, let's get started with our conference call. I'd like to introduce President Liz Bernhard.
Thanks, David, and good morning, everyone. I know we still have some people streaming into the chat, but we want to get started as we have a lot to cover. Thank you for joining us today. I will try to keep my opening remarks brief so that we can really spend time answering your questions. We will spend the next hour or so working to bring clarity and thoughtfulness to many of the questions we've been hearing from clients, and there have been many questions lately. We'll also highlight how we can add value during uncertain times through our advice and our planning expertise. As David mentioned, you are welcome to ask questions during the chat or during the call. You do so by using the chat box in the Zoom screen, and that should be sort of at the bottom of your Zoom screen. And type those questions in. We'll see them, and we'll do our best to work them in as we go. Before we get started and I bring in the other panelists, I just want to make a plug for Albion's first client golf event, which is going to take place on Thursday, May 29th at Soldier Hollow Golf Course. So if we have any golfers on the call today or wannabe golfers, we hope that you will join us for that event. We will be sending out an email invite next week, and that'll have more details, but mark your calendars, Thursday, May 29th. So on with the show, as they say. I am joined by John Bird and Jason Ware, and new to the Albion conference call is Anders Skagerberg. Anders is a senior wealth advisor. He's been with the team about a year, and since he is a first timer, I am going to pass the mic over to Anders so he can introduce himself and tell us a little bit about himself.
Awesome. Thanks, Liz. Yeah, so for those of you who don't know me, like Liz said, my name is Anders Skagerberg, and I am coming up on the 1-year mark here at Albion, and I'm a senior wealth advisor. I've been in the industry since 2017 and actually studied financial planning locally here at the University of Utah. So from there, I went on to earn my CFP designation in 2020, my certified financial planner, and then my enrolled agent as well in 2021. And I like to call that the CPA Light. It's kind of a tax planning designation. So just a quick plug for Albion and how I got here. Albion's actually a firm that has been on my radar since I got into the industry, but my wife and I were actually living down in St. George, so it wasn't a good fit. But we recently moved back to the area, and I applied, I reached out, and ultimately made the move to join the team, and have just been really impressed with the team and the culture, and most of all just the clients that I work with and that I've met so far. So on a more personal note, I do live over in Murray with my wife, Paige, and our 2 kiddos, Ruth and Finn. And we are expecting our 3rd and last baby this summer. So life's definitely busy, but when I get a chance, I do enjoy playing pickleball and then, just cheering on my kiddos at t-ball and soccer games. So yeah, it's me in a nutshell, and really excited to be here at Albion. A little nervous to be on the call today, but really excited to dive in and of course get to know more of you personally over time. So yeah, that's me.
Thanks, Anders. We're delighted to have you on the team, and we'll definitely be hearing more from Anders as we go. But let's dive in. With so much that has been happening so quickly, it's kind of hard to know where to start. I mean, we've seen market volatility, stock market volatility. We've seen volatility in the US Treasury market, the bond market. We've seen the dollar weakening. We've seen gold prices soaring. We've seen consumer sentiment plummeting. And that's all just in the last couple of weeks. And we're in the middle of first quarter earnings. So we're hearing from companies, they're reporting to us on how they did in the first quarter of this year. And arguably more important, what they're seeing looking forward for the rest of the year. So with all of that said, I think the only thing we can really be certain of at this time is that there's a whole lot of uncertainty out there. And so I've asked Jason to start us off today by just giving us an overview of the landscape, paint us a picture where we are right now, from an economic standpoint with the markets, just so as we dive into more details, we can all be on the same page.
Great.
So take
Yep.
it away, Jason.
Thank you, Liz, and thanks everyone for joining today's call. So yeah, the current landscape is one of profound uncertainty. Coming into 2025, the U.S. labor market was healthy. Real incomes were rising. People were spending money. We had a boom in technology CapEx driven by AI and the need for more compute. And there was a sturdy pro-growth fiscal tailwind out there. In addition, inflation continued to come down, and the Fed was prepared to cut rates another couple of times this year. Since about late February, things have changed. While many of these forces are still intact, there are some big questions. There's a lot of anxiety out there as to whether this promising trajectory that I just described can be sustained. Across the desire for austerity at the federal level, otherwise known as DOGE, to anti-growth policies around immigration and, of course, tariffs and trade, households and businesses alike aren't quite sure what to do, what to make of it all. It's really quite dizzying, particularly on the trade policy front. I'll just unpack a little bit of where we've come from and where we are today. The first Trump tariffs took effect on March 4th against Canada, Mexico, and China. Then came tariffs on steel and aluminum. I believe it was March 12th. Some of those were paused, exemptions were made, carve-outs were applied. A couple weeks later on March 26th, it was auto tariffs. And then, of course, came the big one, the 10% universal tariffs and those oddly calculated reciprocal rates, plus 145% tariffs on China, all hitting in early April. It was known as Liberation Day, of course. A week later, they were all paused for 90 days, except for China, where things have gotten worse. Parallel to this, it seems that the group leading the charge within the administration has sort of changed hands over the past couple of weeks, from the deeply protectionist wing led by Peter Navarro and Howard Lutnick, and over to Treasury Secretary Scott Bessent, who's a 35-year financial markets veteran. Almost daily, we hear of this country or that one, sometimes in bunches, supposedly contacting the White House to make deals. Meetings are happening, calls are being made. Are we close? Is this headline or that headline real? Will 90 days be enough? What about the big freeze with China? And what, if any, economic damage occurs while we wait for all of this to play out? There are many more questions than answers right now. And so because of this, the profound uncertainty, of course, there's a tendency to pause some decisions and pause some activity, to slow down on committing capital to big projects, boosting staff, making large purchases, whether you're a consumer or a business, until better clarity is obtained. Nobody likes this. I think few agree that it's the way that we should be handling our affairs. And yet we're all sort of in this economic air pocket for now, just waiting and hoping to get an exit soon. And so that's the 2-minute summary of kind of where we were, what we've experienced, and where we are today.
Thanks, Jason. And certainly we'll dive into each of those areas in more detail. And a 2-minute summary on all of that is pretty impressive. So nice work. Anders, can you give us an overview or, what are the types of conversations that you're having with clients? I mentioned, we are getting a lot of questions. They all are sort of around the same, themes. If you just share, what are you hearing from clients? How are those conversations going?
Yeah, definitely, Liz. Just kind of piggybacking off what Jason said, I think, of course, every conversation is unique, every client is unique, everybody has, different goals and different life views and circumstances. But I think kind of the undercurrent and the main theme right now is people are feeling nervous, things are uncertain, and ultimately people want to know, with everything going on, am I going to be okay financially? And what does this look like for me and my plan? So, I think of all the things we offer here at Albion, one of the most powerful is just being here and available for these conversations during uncertain times. So, first and foremost, I do just want to say, on behalf of myself and the rest of the Senior Wealth Advisor team, please never hesitate to reach out because we're here for these conversations. And then I think, for me, a lot of the conversations with clients right now, it's focused on what's going on in the market and of course, what's going on in the White House and how that might impact a client's plan. And I think, the great thing about the work we do is we're always accounting for periods of uncertainty and down markets. And I've had this conversation with many of my clients, but when we sit down to run a retirement projection together, we use planning software that simulates thousands of different scenarios. It varies the rates of return, it sprinkles in a recession here and a bear market there, and ultimately ensures clients are in a great spot, even in a worst case scenario. So, if nothing else, when I have these conversations with my clients, it's really to validate that this is a very uncertain time. It's perfectly normal to feel nervous, but ultimately the plans that we build are built for good times and bad. So I will say too, I was reviewing my notes last night with my wife, and I went through this section and she was like, I was like, uh-oh, what is it? And she said, I like what you have, but what if people are on the call that aren't feeling nervous? Are they going to think like, should I feel nervous if everybody's feeling nervous? And to her point, yeah, not everybody is feeling nervous. I just had a conversation with a client the other day who is investing a pretty decent sum of money right now. And I said, I just said to them, I said, just checking in, like, how are you feeling with everything going on? And ultimately they told me, Anders, I've been investing long enough that all of these bumps and these periods of uncertainty, they kind of start to look and feel and act the same. And ultimately they told me they're not worried about it. So I think, of course, that is more the exception, but I think it just drives home the point that every perspective and situation is different. And ultimately, how you feel right now is going to look different because we're all different. Um, but yeah, Liz, I think, in quick summary, a lot of people are nervous right now, but we're here for these conversations. And, the good piece is the plans that we build, they account for periods like this and periods that are great. It's a mix of everything. So.
Thanks, Anders. I think it's helpful for you to share that, Justin. We know that if a couple of clients are expressing concern or asking questions, that there are more out there. And so just sharing that those are the types of things that are coming up is helpful. And as Anders said, yes, if please do reach out. I mean, that's what we're here. That's what we're here for. And we're happy to chat. And if you do have concerns, or if you see this as a buying opportunity, as we say, stocks are the only sale people want to run from. So reach out about that as well. Okay, so diving into sort of the details on what's happening, Jason painted us the landscape, and to take some of those items he mentioned and drill in deeper into more detail, specifically starting with tariffs, which seems to be the T word on everybody's mind. And there are a lot of T words out there right now. But starting with tariffs, Jason, you told us kind of where we're at or where we've been coming from this year with tariffs. But what's Albion's thinking on tariffs? Certainly there's the statement of fact, but how are we interpreting what's happening with trade in general? And are we going to be okay? Are we going to get out of this okay?
Yeah. Great question, important question. There's like 8 ways we can go here. So to sum it up, it really depends on the length and magnitude of tariffs. If agreements are hatched and deals are made rather quickly, if we can get a thaw between Trump and Xi, allowing negotiations between the US and China to begin, then I think the US economic cushion going into this, that healthy labor market, solid consumer spending, the business investment tailwinds that I described a moment ago, I think that's enough padding to absorb the soft patch due to tariffs. Growth will slow, but we should avoid a recession. However, if tariffs drag on for months, if a China deal remains elusive, or worse yet, things escalate from here, then I think the base case changes and it must incorporate a higher probability of an economic slump. I think one of the big questions around tariffs is on inflation. Is it going to drive inflation higher, or are we worrying about nothing? And it's interesting. Inflation is such a tricky thing to nail down. The basket of goods and services that make up overall inflation, like the CPI report that I'm sure everyone's aware of, the Consumer Price Index, it's a massive basket, and global forces are at play, and some things zig while other things zag. And I share that because in order to get a sense of potential inflationary impacts, we like to look at inflation by its components, not too deep in the weeds. We try to stay, shift a couple layers up, not eggs versus milk or pork versus beef, but instead looking at broad categories like goods, services, shelter, and commodities. And here, tariffs hit hard and direct one of those categories, goods, while the other three are far less affected by tariffs. In fact, one could sensibly argue that tariffs slowing the overall economy drive down aggregate demand for the other three categories, and therefore prices in those baskets in a way that kind of offsets the goods inflation due to tariffs. For example, the price of oil now is in the low 60s. Moreover, we simply can't know how much of the tariffs will be passed along to consumers versus being absorbed into corporate margins. It'll probably depend on the item, the sector, the company, the present state of the trade war. And so when we add it all up and looking at the pluses and minuses, and that's the only thing we can do during times of great uncertainty, tariffs don't have to be a true inflation shock. It doesn't have to be a true economic shock. Goods prices prior to tariffs, and many of you have heard me describe this before, prior to tariffs, the long-run posture for goods, because of global trade, because of China entering the WTO back in 2001, that global posture was deflationary. It was already deflationary anyway, meaning there's room for upward pressure in the goods category without upsetting the entire inflation situation. So I just want to close and summarize by saying none of this is good. It's terrible policy. I want to be very clear on that. I'm simply saying that it doesn't have to be disastrous. Time will tell. I think the biggest risk on inflation from tariffs doesn't come from direct effects, i.e. tariffs go up, costs get pushed through, and good prices go up, but rather the more indirect ones like consumer and business inflation expectations rising. And we have seen that at the survey level lately, so it's something we're watching, and certainly the Fed and Jerome Powell's watching it as well.
Yeah, this is John. I'm going to speak up for a moment, and thank you all who are on the call for being here. It's always a pleasure to get to have a chance to communicate with you directly. I'd like to make an observation about the tariffs as well. First, parroting Jason, none of us know where this is going to shake out. What we can point to, though, is the way our president has behaved over time, which tends to be full of bluster, putting out some pretty harsh things and then backing off significantly and claiming a victory. It feels like that pattern is continuing as we go through this tariff process, where certainly big numbers, big headline tariff numbers have been espoused, have been put out there, and then been withdrawn. So we are in that process right now. Now, I also completely agree with Jason that this is no way to run a railroad, never mind a company. It's pretty challenging for anyone to make any decisions in such an uncertain environment. But we have watched the tariffs back off considerably, and I think it seems unlikely to us that we'll go back to some of those high headline numbers and stay there. The other thing I'd like to observe is that with regard to inflation is tariffs are likely more of a step function than an insidious disease for inflation. What I mean by that is when tariffs, when they are finally settled and implemented, whatever they may be, that would be a one-time step in prices. And that becomes the new baseline, as opposed to something that's underlying the system that is causing that inflation to continue on into the future. So while we are certainly not sanguine about inflation and the impact of the tariffs, it doesn't feel like it would be an accelerant for inflation that would carry on for years and years.
Thanks, John. On the topic of tariffs and trade policy, Certainly, I think, as John pointed out, it's unlikely that these large tariff numbers that were put out there are really where we're going to end up at the end of the day. We know this is a period where there's going to be negotiations by country to determine what that final tariff number will be. I'll put this question, Jason and John, what do you think the White House's goal for tariffs are? Really, ultimately, all of this is to get us where?
Yeah, I'll jump in. Oh man, it's hard to say. Is the short answer. It feels like it changes almost daily and depends on who you listen to. One school of thought says it's about eliminating trade deficits entirely because any trade deficit means we are being ripped off. Of course, this is not the case and runs afoul of basic economic laws and international trade finance. In my view, this cannot possibly be the goal because it's impossible to achieve. Other factions in the administration suggest it's about moving manufacturing jobs back to the US. This is a difficult thing to do for a variety of reasons and a goal not likely to be accomplished with tariffs. And then there's a totally different group that says it's about reworking bad prior trade deals, including non-tariff trade barriers, is what they call them, to make things fair for American consumers and American companies. I think there's some truth to that last one, but tariffs alone are a pretty blunt instrument and only likely to work as a negotiating tool to get people to the table to make some of those unjust practices right. So I think the latter is probably the aim of it's probably the goal of the administration now, especially now that Scott Bessent is running trade negotiations. So I would just use that to echo what John said. There's a lot of volatility in opinions on trade, even coming from within the White House. And it feels like if you want to accomplish something, you have to get people to the table. So these tariffs are likely tools to get people talking so we can negotiate down. Now, to be clear, we're going to be at a high, when we're done with this, it's very likely, unless we have this like global free trade agreement, it's very likely that tariffs will be higher when we're done than when we started. The average tariff rate in the US was like 3% when we started this. Even if we took off all the reciprocals and went back to the 10% baseline, we're going to be closer to 10%. So tariffs are going to be higher probably, but I don't think they're going to be as high as, like John said, the Trump's using to get people to talk.
It's a good observation, Jason. And when I have followed the man who's now our president for a few decades, he has been quite consistent over years and years that we are getting ripped off if we run trade imbalances. And I question his understanding of economics, but I accept that that's his ideology. And so I think that one level, that's his feeling. I think what he tends to do, though, and you're trying to get inside the mind of Donald Trump is a frightening place. I really don't want to be there, but we'll work on it. What I think he's trying to do is get to that, but we have the wiser voices such as Scott Bessent, who understands how markets work, who have his ear, which are causing him to say, all right, what's possible? This is what I'd love to do is have no trade deficit with anyone, which we could spend an entire hour talking about why that is really illogical. But I think that wiser heads or people with more understanding, I should say, have gotten a hold of his ear, as well as the markets have gotten his attention to start changing that and realizing, okay, what makes sense here as opposed to what does ideology suggest?
Speaking of markets, it seems that we've hit a rough patch. January was positive if we're looking at broad market indices in terms of performance, but we started to see a rollover in mid-February, and we've had a rough patch since then. Jason, how would you summarize what's happening with the equity markets?
So the other day on CNBC, I called it a flash bear market. Peak to trough, the S&P 500 fell 21%. The NASDAQ was down 27%. Mag 7 was down 34%. Small caps were off over 30%. The average stock was lower by over 25%. I could go on. And this all happened rather quickly, within the matter of a few weeks. We've since bounced from those lows. and we're now about 12% off of prior highs. So that phrase, bear market, no longer holds true in terms of market definitions. But look, it doesn't really matter what title we put on it. We're firmly in correction territory right now. Stocks are in a drawdown. It's no fun out there. But history teaches us that there's often a pattern to sell-offs, textbook price action, if you will, that's driven by things that are timeless and quite consistent across cycles. The impact of the economy and corporate earnings on equities, the emotions of fear and greed, and investor behavior. And so here's how we're thinking about it using that historical framework. Typically what happens with corrections is we fall 10% because markets know or kind of sense that something is not right. In this case, it's tariffs and Trump harassing Jerome Powell. Now, if it all ends up being okay, then we rally and everyone forgets about it and we move on. And that's like a garden variety correction. Last August with the yen carry trade unwind, that was an example of this. Most probably don't even remember that, but we fell about 10% in early August of 2024 and rapidly came back when nothing bad came of it. But if the thing driving the 10% correction ends up getting worse, then stocks can fall more, sometimes down 20% or more. That's the bear market level, at which point markets then have discounted a fair amount of bad news. We saw that after April 2nd, Liberation Day, or maybe Obliteration Day if you're financial markets. Inevitably, you get a rally from those oversold conditions, like we saw when we got the 90-day tariff pause, and the Nasdaq was up 12% that day, and the S&P was up 9.5%. Or like we're experiencing now, the past couple of days, now that Trump has said he won't try to fire Jerome Powell. We've had a pretty big bounce in markets the last 2 days. And so when you get that relief rally, you bounce back to what I call the scene of the crime, if you will. It's where stocks first broke down. And that's where you await new information on which direction to go. And that's pretty much where we sit today. Like with so much we've discussed, markets, financial markets, stocks, bonds, et cetera, are also waiting to see where this stuff goes. At its core, if we avoid recession, which comes with lower corporate earnings, then we probably get through this period without much more damage. We'll bounce around in a trading range while this stuff gets sorted out. However, as we've discussed, if tariffs stick around too long, or if the trade war gets worse, we can't get a deal with China, then we probably haven't seen the lows yet, because stocks will then begin the work of more vigorously pricing in a recession. And hopefully that's not where we're going to land. It's not our base case, but we'll see what happens.
And Jason, it's worth pointing out, you were sharing some information with us internally the other day with regard to during a bear market, you have tremendous number of really big up days. And then coming out of a bear market, you sort of have about a 38% move before we even know we're out of the bear market. So the notion is, if you're trying to say, well, gosh, I'm going to time this, the odds of successfully timing it are close to nil. Yep. I mean, I think back across my history of investing, and the first really big down market we had was 1987. And oh man, as a young John Bird was terrified. And we raised a lot of cash and we felt really good about that. And then the market recovered, and by the end of the year, it was actually up for the year.
Yep.
Point being that owning good companies and riding good companies through these troughs pays well. Attempting to skip the trough means you're really, really likely to miss the big upside as you come out, because you will be scared as the market's going up. You will not trust it. So our mantra does cycle back to just own good companies.
I love the example of 1987. I use that one often too, John. It's what I call the Rip Van Winkle year in the stock market, where if you fell asleep on January 1 and woke up on December 31, you'd look at the Dow and say, it was a boring year. I think it was up like 6.5%, which is like perfectly average over time. And yet we all know what happened in the fall. We had the Dow down 22% in one day on Black Monday. So the ride can be bumpy, but over time things smooth out, and we think this too shall pass.
So there was a question that came in, and Liz, I don't want to usurp your position here, but I guess I am, that was about confidence and funding our deficits. And if other countries no longer believe in the security, what is the risk of other countries no longer believing in the security and sanctity of the dollar, which will cause a sell-off in dollars and perhaps cause us to pay more in interest to fund our own debts and deficits?
I'm going to let you go first, John.
Yeah, okay, good. Wow, I love that. I get to ask the question and answer it.
Yep.
Short answer is it's a great question. That is a concern. The U.S. has been in a wonderful position since the end of World War II, where the dollar has been the global currency, which has given us tremendous advantages in terms of our ability for our businesses to conduct international business, for our country to finance our own debts and deficits. It's been a tremendous advantage. We have seen in this last sell-off, we have seen stocks go down and bonds go down at the same time, which means interest rates going up, the cost of our debt going up. My take is that will likely stabilize. We're still the 800-pound gorilla. We have policies being put out there that are fairly quickly withdrawn. So the net of it, I think it might end. I mean, a possible scenario is we end up with the Rip Van Winkle presidency, similar to the 1987 Rip Van Winkle year, or this becomes a Rip Van Winkle year where we end up at the end of 2025 with, okay, we started the year with 3.5% average tariffs. We ended the year with more, 6% average tariffs. I'm making up a number here, which if you just saw those two data points, you'd say, well, all right, not a lot happened. Now, we all know a lot is happening, but my suspicion is that I'm going to circle back to golf, which we're having a golf event. It's like golfing with me. At the end of the round, my score is pretty bad, but it's consistent. On any given hole, it might be way up or way down. So if you finish the round and you're golfing with me, you'll go, okay, Bird shot way over par, but he was consistently over par. Any given hole, it's a wild card. I feel like that's what we're going to have through this year. And I think with regard to funding our debt and deficits, we will pay a little more, but I think as we finish this year out, we will likely be back in a pretty stable state.
Yeah, I would echo a lot of what John said. I believe if I heard the question correctly, there was a comment in there about the dollar is low relative to other currencies, and I would push back on that a little bit. The dollar is off of what were some very high levels. So I think let's begin with a little bit of perspective and context. From 2020 through 2024, we had a pretty unrelenting and elevated period of US dollar strength for a variety of reasons that we don't have time to get into, to a level that was arguably too high to be reasonably sustained, let's call it that. And so this situation alone probably needed to normalize a bit. And I think the Trump tariff shock, calling into question America's leadership role on the global stage, was as good a reason as any to kind of reset things. Prior to the 2020 to 2024 period, when looking at, say, the US dollar index, it's what's known as the Dixie, which is a measure of the dollar against a basket of some of the largest global currencies out there. We spent much of the 2010s up through the pandemic, so 10 plus years, at a level about between 80 and 100 on the dollar index. We reached 109 after the election, but right before Inauguration Day. And today we stand at just under 100. And so, in all honesty, I don't view recent softening as concerning yet. Like John said, I think it's a reset. I think it's stabilizing. We're still at the high end of what's been a pretty normal 20-year range. So for me, I probably won't get too nervous unless we see a true breakdown of the dollar to say maybe under 90 on the dollar index, with an accompanied rise in US yields to something like 5% or higher on the 10-year. I think things have settled down for now. The market is Scott Bessent, Donald Trump, et cetera, et cetera. I think they're paying attention to what the market's telling them about this trade policy they're trying to pursue. And so I suspect we've seen the biggest pieces of those moves. We saw yields back up quite a bit, and we can talk about that more in a minute. But I largely agree with John. I think we're settling in here.
Okay. I'm going to pivot back to our conversation about what's been happening in the markets, and sort of follow on to John's statement where it's really about owning good companies. And those of you who have been working with us for a while probably have heard us talk about owning good companies multiple times. And we have clients who ask, okay, Albion, you talk about owning good companies. How are those companies doing in this sort of volatile environment? I mean, it's not sort of, it is volatile. In this volatile environment relative to the market writ large, the broad market. And so just want to ask Jason to start off and add some context there that goes along with our statement of owning good companies.
Yeah, it's a great question. And I like to say own great companies. So my bar as an analyst is very high. Two views here. There's the lens of stock prices and the lens of company fundamentals. And I'll take a brief moment on each. So on stock prices, obviously we have no control over markets. In the short run, they go up, they go down, they go sideways. Again, we have no say in the direction. And so are our company's stock prices doing better, the same, or worse than the indexes like the Dow? I mean, it depends on the day, it depends on the month, it depends on the year. Those things are driven by short run forces like fund flows and headlines, general investor mood, which impacts PE multiples. But in a general sense, quality companies, which are the companies that we prefer, they tend to be the ones you want to own when times get tough. They also tend to be the ones you want to own in good times. We like secular growth companies. You've heard us talk about secular growth. And so given the often erratic nature of financial markets over short stretches, we're seeing that right now. Our bent is to not pay too much attention to what Mr. Market says about what our stocks are worth at any given moment in time. On company fundamentals, this is where we really, truly measure our success. While we can't regulate stock prices, as I just mentioned, we can control the types of businesses we buy. And we do have a say in the type of analyses that we conduct when deciding if a company has investment merit. And here, across revenues, earnings growth, cash flow metrics, balance sheets, return on assets, selecting good management teams, our collection of businesses has and should continue to outperform the averages. We're currently in Q1 earnings season, as Liz mentioned, and we're pretty happy, all things considered, with what we're seeing so far from the companies we own, both in terms of results from the prior quarter, first quarter, but also these companies' outlooks. There was a lot of analysts going into earnings season, a lot of folks on Wall Street saying companies are going to suspend guidance. They're going to cut their guidance because of what's happening with tariffs in the economy. And yet what we've seen from our companies is most, if not all of them so far, and we're early on, but most of them have either reiterated their guidance for the year, or in a couple cases, they've increased their guidance for the year. Imagine the confidence you must have in a good business to increase your outlook for revenues and earnings, given all that's going on. And so ultimately, over time, those two things converge, stock price and company fundamentals. The single metric with the strongest correlation to stock prices over time are profits. And so it's our belief that if we aim to target just one thing, it's the combined earnings growth of the portfolio. And if it's higher than that of the market writ large, and we're careful about the multiples and valuation we pay, Howard Marks likes to say it's not about buying good assets, it's about buying good assets well. And that's an important nuance. The rest takes care of itself over time. We think you can't arbitrage patience and long-term thinking. So we own great companies, we diversify the portfolio, and we think and act long-term. And so that's how we're thinking about our companies, our stocks, relative performance at both layers, and what we plan to do about it.
Thanks, Jason. And just providing some context, when we talk about owning good companies and our companies, giving forward guidance that is, at least upholding what they thought that would be for the year, or even increasing it in the environment that we're currently in, that is not what all companies are doing on their first quarter earnings calls. We're seeing companies not give any guidance going forward because they don't know what to think, or issuing two sets of guidance. Well, if these conditions happen, then this is what we think, but if these conditions happen, then we think something different. So I think that really highlights what Jason said about what can we control as investors, and with our analysis and targeting those companies that have strong earnings growth is significant. Anders, let's talk about how the market and what's happening in the market is impacting clients, And, I think one of the questions that we get from clients during this time is, should I be changing my investment plan? Or if not, what should I be doing? And we often talk to clients about, we want to change your investment plan or your allocation based on what's happening with you and not based on what's happening with the market. But talk to us about that.
Yeah, definitely. It's a great question, and inevitably it comes up in times like these. But Liz, to your point, the short answer is no. We typically don't want to make reactive changes to our investments during periods of volatility, and that's for a couple key reasons. The first, and this is something John just touched on a little bit, but jumping in and out of the market can be very costly. And studies show that if you miss just the 10 best days over a span of 30 years, your returns can be cut in half, which it's significant. It's just 10 days over 30 years. And of course, to John's point as well, the kicker is no one knows when those 10 best days are going to happen. And the icing on top is that they tend to be grouped right alongside the worst days. So in other words, the times that we're tempted to jump out is when those best days often show up. And then the second piece to your point, is your investment plan is really tailored to support your life and your goals and your unique time horizon. So we want to review these things and adjust your investments when major life changes occur. If somebody's approaching retirement, that's typically a time where we look at your investments, or if there's a significant change in income or expenses or a shift in goals, all of these factors drive that decision to change the investment plan, not the ups and downs of the market. So that's kind of the first piece of, should I change my investments? And again, the short answer is no. But for the next part of the question, what should I be doing? It sounds very cliche, but ultimately sticking to the plan and remembering that as long-term investors, we are rewarded for being patient, and just realizing that, your plan is designed to support you through the good times and the bad. And second, something I do with my clients that can be helpful is just reviewing your cash reserves, not even making any changes, but just taking a look and reminding yourself, I do have this emergency fund. I do have this cash on hand. If nothing else, it can help remind you that you do have this buffer in your life, and that's there for these periods. And then I think lastly, if anything has changed, it's a great time to reach out. If you're planning to retire sooner, or you've got a big move coming up, or you're building your dream home, any of these things that are major life changes, and if you're feeling uncertain, just reach out. Let's have a conversation. And that's ultimately what we do, as we help navigate those big decisions. So yeah, I think in summary, we want to avoid being reactive to the market and really let life changes drive those investment changes. So
I think oftentimes when we are nervous about the future, we feel like we need to do something, right? We're compelled to do something as humans, and oftentimes not doing something, although from an investment standpoint, can be the best thing, because that we know that volatility clusters and the good days and bad days are often right next to each other. But not doing something can be actually pretty tricky to do. And so I'm glad that we have, our senior wealth advising team that's here to help clients remember that. Anders, while you have the mic, talk to us a bit about planning opportunities, that are available right now. And these may not apply to all clients, but with the market and with what we're seeing right now, there are some unique planning opportunities to take advantage of.
yeah, definitely. And I love this question because it's essentially, it's like, with everything going on, what are the silver linings? Like, what can we do? What are the, opportunities we can take advantage of during a market downturn? And, to your point, the funny thing about planning is every single question, the answer could be, well, it depends on your unique scenario. So I'll cover a few strategies that may apply for some, but won't apply for others. And I'll do my best to avoid getting too far into the weeds, but we'll see. So I think the first one is obviously tax loss harvesting. I think a lot of clients have heard us talk about this, but for those who aren't familiar, in taxable accounts, so this is any non-retirement accounts, if you have any positions that are trading at a loss, which during times like this, you may, we sell those on your behalf, capture the losses, and turn them into tax savings. So the nice thing too is we still want to stay invested, so we hold the funds in what's called a proxy security, so something similar but different, and then buy back the initial security within 30 days. So in the meantime, you're staying invested, you're capturing these losses to offset gains or offset ordinary income up to a certain amount per year. And the nice thing is we do this multiple times per year on behalf of our clients. So it's something that's always happening in the background. I know we just finished a round of tax loss harvesting recently. So that's one thing, it's when life hands you lemons, you go and you tax loss harvest. So the the next piece is Roth conversions. And again, I'll do my best not to dive into the weeds here, but essentially a Roth conversion is when you have money in a pre-tax IRA, so you're gonna pay taxes when you take it out, you can convert that into your Roth IRA and get it into that tax-free bucket. Now there's a couple catches. First, when you do that conversion, you will pay taxes on the conversion. So the whole strategy here is to figure out lower tax years that you can get money out at opportune times so that you'll pay less in taxes over your lifetime. You shift that money over to that tax-free bucket. So they're not for everybody, but if you're in a situation where you're already doing Roth conversions, when there's a down market, if you're converting $75,000 per year, you're just buying more shares in that Roth bucket because the share price is lower, essentially. So best way to think about it is if you're already doing Roth conversions and you have a downturn, you're just getting more bang for your buck when you do those Roth conversions. So that's a nice little silver lining. And then I think, kind of the last piece is for anybody that is contributing to accounts, or, if you've had the sale of a business or an inheritance recently and you have some money that you're looking to invest, typically the research shows lump sum investing is the way to go. Now, that doesn't mean that everybody will lump sum invest. So if you are dollar cost averaging, if you're buying, a certain amount every week, in a downturn, it can be a good time to either accelerate or increase those contributions because, again, everything's on sale. If stocks are down 15%, that means you're getting more shares at better prices. So can be a good time to either accelerate or increase those contributions if you're in a situation where you are contributing.
Thanks, Saunders. Those
Yep.
are good strategies, and as you said, may not be applicable to everyone, but for those who, it is applicable for, if you have questions, reach out to us. That you did not get too into the weeds there, Saunders. You did a great job keeping it high level, but making it very understandable. So thank you. I'm going to pivot back sort of towards the financial markets now. And we dabbled in this earlier with the question about debt and deficits. But, we've seen some moves in the U.S. Treasury market lately. And that's not a market that usually we spend a lot of time talking about on this call. But given what we've seen recently and the impacts for our debt and deficits, Jason, talk to us, give us a little bit of an education on what's happening here, what we've been seeing, and why it matters.
Sure. So specifically around the 10-year treasury, which is where I think most folks are paying attention, the front end of the curve, the short end of the curve, the Fed controls that pretty closely. So it'll move depending on what monetary policy does, what Powell does in terms of cuts. But on the 10-year treasury, after an initial drop in yield due to growth concerns around tariffs, Trump's announced reciprocal tariffs on April 2nd. That sent yields suddenly and dramatically higher In a matter of a few days, the yield on the 10-year went from just under 3.9%, and that was after investors started getting a little bit worried about, well, are tariffs going to slow growth? And if they slow growth, people move to buying bonds, and that pushes yields down. But we went from 3.9% to 4.7% in a matter of just a few days. It was one of the most aggressive moves in the treasury market. And by the way, the US Treasury market is both deep and very liquid as far as sovereign bond markets are concerned. And so that move was very aggressive. That got the attention of Trump's economic team, in particular Scott Bessent, and was a major reason they stopped short and put the 90-day pause on tariffs a couple of days later. So it turns out that the Trump put that you've heard a lot of us, myself especially, talk about a lot over the past few weeks was in the bond market every bit as much as it was in the stock market. And since the pause, yields have fallen and settled down again. We're sitting at around 4.3% on the 10-year right now. And it remains a key gauge to watch regarding investors' views on the economy, inflation, and tariff policy. So that's been the movement we've seen over the past couple of weeks. And it was both shocking and spoke very directly to what's happening in Washington, D.C. And thankfully, some of the adults in the room, for lack of a better phrase, were paying close enough attention to give good advice on, hey, we should pause and rethink what we're doing, and let's try to make some deals. Let's not make eliminating trade deficits our goal, because that's an impossible goal and we'll stay here forever and we're going to cause all sorts of disruption and dislocation. So moving away from that, I just want to touch on how we're looking at the treasury market structurally speaking. We think the 10-year yield in equilibrium, and that takes into account, you've heard me talk about this on past calls, that takes into account the Fed's neutral rate, which is essentially inflation plus what economists call R star, which is the level of real rates. And then it adds a reasonable term premium to that. And a term premium is to be thought of as just higher compensation to hold longer dated bonds. When you add all of those things up, that should put the 10-year treasury, again, in structural equilibrium, which is more of a theoretical concept, but it should put things about where it is currently, maybe plus or minus 0.25% or 0.5%. Over the short run, there's always volatility around where yield should be. We're seeing that. We have seen that, driven by expectations for growth, inflation, Fed policy, geopolitics, and investor mood and risk appetite. But the way that we think about the 10-year bond, which of course is the reference rate for so many things, including mortgages, is that 4 to 5%, given our assessment of conditions, seems about right to us. Again, we're going to see movement. We'll probably continue to see volatility in financial markets writ large, including the treasury market, because of the uncertainty around policy, in particular around tariffs and trade. But as we move past this, and again, our expectation is that we will, the 10-year yield in that range seems about right to us.
And I just want to highlight, thank you, Jason, and highlight that the reason why, as you mentioned, this matters to people is the impact, the impact that the yields have on other interest rates we pay, mortgage rates, car loans, credit card rates. So it does impact the broad economy, not just people who are investing in U.S. treasuries. You mentioned the Fed, and I know we only have a few minutes left here, and so I will kind of try to keep this as our last market economic question, but I feel like we have to at least just touch on what's happening at the Fed level, or what we're seeing, which I think is a whole lot of nothing at the moment, but maybe just walk us through that.
Sure. So there's a couple of perspectives here. There's the mechanics of Fed policy and the more fundamental side. And I'll just touch on both briefly. I'll start with the mechanics. Say Powell cuts due to the mess tariffs are causing, and then the White House suddenly announces a deal or deals or rolls back all the tariffs. Then what? Does Powell and the Fed immediately take back those cuts? The Fed isn't a body that likes to lurch back and forth between the brake and the gas. And so mechanically, Powell is in a difficult situation and really has no choice but to wait and see what Trump does on tariffs, what the end game is and how this all plays out, because he doesn't want to inject lower confidence in the Fed's ability to be objective and see through. Like John mentioned early on in the call, that tariffs are to be seen as like a transitory, not to use that word. I should have used that in terms of inflation. We know how that worked for Powell, but tariffs are seen as like a one-time step up. It's a one-time step function, and then core inflation takes over from there. So the Fed usually looks through that type of thing, and they certainly don't want to be guessing what the administration is going to do on tariffs and reacting with moves on monetary policy. On the fundamental side, and this is the most important side, the Fed has two congressionally designated mandates: maximum employment and price stability. These tariffs, this needless trade war that we're all engaged in, places the Fed in a tough spot on the fundamental side as well. Tariffs threaten both inflation to the upside and growth to the downside. And so if you're Jerome Powell, which side of that twin mandate do you address? And it's why I think we've seen so much when we hear Powell talk and some other members of the Fed talk, they're in wait and see mode. I think at first, especially after the post-pandemic inflation spike that we're now kind of getting past, you probably concentrate more on inflation. That's what Powell's been saying lately. If it comes down, but it has come down, but it's still above Fed target is the best way to think about that. And they really want to anchor that. They don't want to move too soon and get reduce rates at a rate that allows inflation to pick back up. Meanwhile, if the economy remains in decent shape, slowing, yes, but not anything worse than that. So this all kind of goes back to that balance between the economy and inflation. I think if this all goes on too long, the trade war and tariffs, and joblessness begins to rise, Powell will have to eventually shift over to supporting growth in general to arrest rising unemployment. But also because economic downturns are inherently deflationary, like he'll have more room to maneuver on the inflation side. So he's in a tough spot. I don't think they're going to do anything imminently, but we do think that if we get past this in somewhat short order, the Fed can get back to the path they were on with rates, and that's probably a couple cuts short term. One other final thing I'll say is if risks to financial stability arise, and let me be clear, we don't yet see those in play, and we certainly don't hope they come into play. But if those were to bubble up, the Fed has a range of liquidity facilities that I would expect them to deploy, just as they did in 2008. And just as they did in 2020. Again, that's not our base case. We're not seeing stress like that in the market. I don't think we're going to get there, but the Fed has tools.
Thanks, Jason. John, do you want to take us out on your observation about where we are today versus several months ago?
Sure, Liz. I'd love to. A couple of things I'd like to note. In the time I've been in this business, we have had several descents into the chasm. And when you're descending into that chasm, it's fully socked in. You have no idea how deep it is, and you absolutely can't see the other side. Every time we've gotten to the other side and come out stronger. This will be no different. Every case is a little bit different, and this one has its unique characteristics. But we continue to believe in the resilience of the United States economy and the passion of every one of us to get up every day, go to work, and do it better, faster, cheaper. That has not changed. The quality companies that we own in your portfolio, that you own in your portfolios, will continue to do that. Another thing we'd like to observe is, I'd like each of you to ask yourselves, how did I feel last August, early September, with regard to my net worth? Did I feel pretty good? Felt like I was on track? And I think certainly in our conversations with you, you were feeling good. You were on track. Well, that's about where the markets are now. They've retraced gains back to about where we were August, September 2024. So it feels dire, and that's the way these markets work. The volatility is painful. It feels dire. The reality is we're not that far set back. And we are seeing, as Jason alluded to earlier, mentioned earlier, the Trump put, which is when the markets get really crazy, our president doesn't, or crazy as in going down, our president doesn't like to see that. At some level, he measures his success against the markets and will come in and intervene, or basically withdraw the policy pronouncements that have caused market declines. So I'd ask you all to think through and certainly reach out to us if you want to talk about the specifics of what you own and why you own it. You may find it helpful to go through that exercise and realize, you know what, we do own good companies. The world's not coming to an end, and have a lot of gratitude for the lives we get to live.
Thanks, John. That's a great closing note. Thank you, everyone, for joining us today. We're just 2 minutes over time. I'll take that as pretty good on keeping to our timeline. As you've heard us say, give us a call, reach out if you have any questions. And also, as always, if you know someone who could benefit from the work we do on behalf of our clients, please introduce them to us. Thank you and have a great rest of your day.